Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Citigroup Inc. Annual Report. Citigroup Inc., a diversified financial service holding company, offers a wide range of services to various clients. The company operates through 5 segments: services, markets, banking, U.S. personal banking, and wealth. The services segment provides treasury and trade solutions, securities services, and cash management services to multinational corporations, financial institutions, and public sector organizations. This includes cross-border support, local market expertise, post-trade technologies, data solutions, and various security services solutions. In the market segment, Citigroup offers sales and trading services for equities, foreign exchange, rates, spread products, and commodities to corporate, institutional, and public sector clients. The company also provides market-making services, including asset classes, risk management solutions, financing, and prime brokerage. The banking segment includes investment banking services, such as equity and debt capital markets-related strategic financing solutions, advisory services for mergers and acquisitions, divestitures, restructurings, and corporate defense activities, and corporate lending. This consists of corporate and commercial banking services to retail and small business customers. In addition, the U.S. personal banking segment provides proprietary and co-branded card portfolios, as well as traditional banking services to retail and small business customers. The wealth segment offers financial services to high-net-worth clients through banking, lending, mortgages, investment, custody, and trust product offerings. Overall, Citigroup Inc. operates globally in various regions, including North America, the United Kingdom, Japan, North and South Asia, Australia, Europe, the Middle East, and Africa. Citigroup Inc. has experienced a significant increase in its stock price over the past year, exceeding 51.53%. This surge can be attributed to a combination of strategic transformations, improved financial performance, and a more favorable economic and regulatory environment. One key factor contributing to this rise is Citigroup's strategic reset and restructuring efforts under CEO Jane Fraser. The company has streamlined operations, divested non-core consumer banking businesses, and focused on high-return sectors such as wealth management and institutional banking. This realignment has bolstered investor confidence and led to greater operational efficiency. Citigroup's improved financial performance has also played a significant role in its stock price increase. The company reported strong financial results, including beating fourth-quarter profit expectations for 2025, largely due to a robust recovery in deal-making and increased corporate client activity. Additionally, the bank saw a significant rise in net income in the fourth quarter of 2024, with revenue increasing by 5% excluding divestitures and a 17% uptick in fee revenue. The favorable macroeconomic and regulatory environment has also positively impacted Citigroup's stock price. The easing of regulatory oversight and the Federal Reserve's interest rate reductions in 2025 have led to an increase in net interest margin and stimulated deal-making activity. Furthermore, the bank's investment banking expansion and M&A activity have driven growth, with a 35% year-over-year surge in investment banking fees in the fourth quarter of 2025. Cost-cutting measures, such as reducing its global workforce by 20,000 employees by 2026, have also led to significant cost savings that are positively impacting the bottom line. Additionally, aggressive share repurchase programs have contributed to the growth in earnings per share. Wall Street analysts have issued optimistic forecasts for Citigroup, with several upgrading their price targets and expressing bullish sentiment on the company's transformation progress and future growth prospects. Overall, Citigroup's stock price increase can be attributed to a combination of strategic transformations, improved financial performance, and a more favorable economic and regulatory environment. As the company continues to execute its strategy and navigate the changing market landscape, investors remain optimistic about its future growth prospects. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth at Citigroup can be attributed to several key factors. One major contributor is the increase in consumer loan securitizations, which rose by 50% year-over-year. Additionally, mortgage servicing rights (MSRS) fees increased significantly, reaching $149 million in 2025. The bank also saw a substantial rise in resecuritization transactions, with a transfer of agency securities valued at approximately $31.8 billion in 2025. On the other hand, revenue decline drivers are largely influenced by external factors such as downgrades in credit ratings, which may lead to additional collateral or settlement requirements. The sales of financial assets also contributed to revenue decline, with a derecognition of $8.2 billion as of December 31, 2025. Furthermore, fair value changes of total return swaps resulted in significant losses for the company. It is worth noting that while certain areas such as loans held for sale and non-marketable equity securities experienced declines, these were not necessarily driven by revenue growth or decline factors. Instead, they may be indicative of broader market trends or shifts in asset valuations. The net income of a company has shown an upward trend over the past 3 years, with a 13.2% increase from 2023 to 2024 and a further 18.5% increase from 2024 to 2025. This growth in net income is reflected in the improvement in return on equity (ROE) and return on assets (ROA), which increased from 4.3% to 6.8% and 0.38% to 0.54%, respectively. However, profit margins have been more volatile, decreasing by 4.9 percentage points from 2023 to 2024, but increasing by 1.1 percentage points from 2024 to 2025. This fluctuation can be attributed to various factors, including a one-time gain of $9,300 million in 2024 and the sale of Banamex, which led to a decrease in net income, but an increase in net income due to the reclassification of CTA loss. Segment-wise analysis reveals that profit margins have been negatively affected by certain segments, such as AO Citibank, where margins were negative in all 3 years presented. Additionally, the Poland consumer banking business experienced a decline in profit margins due to a pre-tax loss on sale of approximately $181 million in 2025. Risk analysis highlights changes in various risk categories, including interest rate risks, foreign exchange risks, equity risks, commodity and other risks, and credit products and risks. While some risks have decreased, such as interest rate risks, -32%, and commodity and other risks, -45%, others have increased, such as foreign exchange risks, +59%, and equity risks, +67%. The company's financial performance indicates a consistent generation of positive operating cash flow. This trend is evident across multiple pages of the extracted summaries, where it is stated that the company generates positive operating cash flow in various years, including 2023, 2024, and 2025. The data also shows significant operating cash flows, with amounts exceeding $7 billion in some instances. Furthermore, net cash provided by operating activities is consistently positive for all 3 years, reinforcing the notion of a strong financial position. Overall, these findings suggest that the company is successfully generating positive operating cash flow, which is a crucial indicator of its financial health and stability. The company's debt level has undergone significant changes over the past year. According to the extracted summaries, total debt has increased in several instances, with notable increases of $6,989 million and 6.4% from $1,031,362 million to $1,097,216 million. Long-term debt has also seen an increase, rising from $174.5 billion to $185 billion. These changes have likely led to fluctuations in interest expenses. Interest paid during the year has increased by $294, and specific interest expense figures show a rise of $399 million from $6,680 million to $7,079 million. However, there is also evidence of a decrease in interest expenses, with a gain of $323 million from -$1,073 million to -$750 million. Overall, the data suggests that both debt level and interest expenses have undergone significant changes over the past year. The financial performance of various segments and regions has been mixed in the recent period. On a positive note, the banking segment saw significant growth with 32% revenue increase and 52% income growth. The wealth segment also performed well with 14% revenue growth and 49% income growth. In terms of regions, North America led the way with 19% revenue growth, followed closely by international with 11% growth. However, not all segments and regions fared equally well. The all other segment saw a decline of 41% in revenue and 81% in income. Retail services also performed poorly due to a decrease in credit card spend volume and higher credit losses. In terms of regions, Europe experienced a 2% decline in revenue, while the Middle East, Africa, and Russia (MEA) region saw a -6% decline. Some segments and regions showed mixed performance, with both positive and negative growth rates. For example, advisory saw a 53% increase, but also a 22% decrease. Similarly, Japan, Asia North, and Australia (JANA) experienced a 52% increase, but also a -11% decrease. Overall, the financial performance of various segments and regions has been varied, with some showing significant growth while others struggled. Citigroup's management outlook and strategy management at Citigroup is optimistic about the company's future performance, citing strong results in certain areas such as other revenue. The company has made significant investments in available-for-sale debt securities and Level 3 assets to drive growth and profitability. A key focus area for Citi is risk management, with a multi-year transformation underway to strengthen controls and mitigate potential risks. To remain competitive in the highly competitive financial services industry, Citigroup must continue to invest in its brand name, product quality, distribution channels, and employee retention. The company's investment strategy involves maintaining a globally diversified portfolio across various asset classes to meet benefit obligations. Management is also prioritizing debt reduction, with $141 million in debt reduced so far. Overall, Citigroup's outlook and strategy are centered on growth, risk management, and improving profitability through strategic investments. By focusing on these key areas, the company aims to drive long-term success and remain a leading player in the financial services industry. Acquisitions and divestitures overview. The extracted summaries reveal a comprehensive list of acquisitions and divestitures made by the company. Upon reviewing the data, it is evident that there were no significant acquisitions mentioned in most pages. However, one notable acquisition was the purchase of credit-deteriorated assets, PCDAs, and over-the-counter cleared, OTC-cleared, derivatives in page 325. On the other hand, divestitures were more prominent, with several notable transactions. The company sold its AO Citibank on February 18, 2026, as mentioned in pages 3, 126, and 155. Additionally, a 25% equity stake in Grupo Financiero Banamex, S.A. de Civi, Banamex, was agreed to be sold in page 3. Other significant divestitures include the sale of Poland consumer banking business in page 4, Banamex in pages 50 and 127, and a trust business in the third quarter of 2025 in page 28. The company also reported business exits in various countries, including Netherlands, Argentina, Brazil, India, Russia, and Mexico. Furthermore, the sale of Travelers Life and Annuities long-term care business to GE Life, now Genworth Financial Inc., through a reinsurance agreement in 2000 was mentioned in page 314. The company also voluntarily dismissed itself from a case on November 8, 2023, as stated in page 325. In summary, while acquisitions were minimal, divestitures were more prominent, with several notable transactions across various countries and business segments. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. According to various pages within the document, the company has paid out significant amounts in common dividends, with $4.3 billion being mentioned on multiple occasions. Additionally, the company has also engaged in substantial share buyback activities, with $13.3 billion being spent on repurchasing common shares. The evidence from different pages confirms that both dividend payments and share buybacks have been a part of the company's strategy to reward its shareholders. The amounts paid out in dividends and the number of shares bought back are consistent across multiple references, indicating a clear commitment to returning value to investors. There are some concerns regarding inventory buildup or supply chain disruption that could impact Citi's operations. According to page 51 of the report, disruptions to business operations and supply chains can increase regulatory and compliance risks and costs for the company. Additionally, changes in inventory levels have been linked to a decrease in average trading value at risk, VaR, from $6 million in 2024 to $0 in 2025, as mentioned on page 111. However, it's worth noting that these concerns are not widespread throughout the report and appear to be isolated incidents. Overall, the majority of pages do not mention any significant issues related to inventory buildup or supply chain disruption. That concludes the financial summary for Citigroup Inc. Feel free to comment below, and I will be happy to answer them when possible.